Many traders make the market far more complicated than it needs to be. They constantly switch between indicators, chase new signals, and search for the perfect strategy, only to end up overwhelmed and confused. Yet, some of the most valuable lessons in trading come from understanding a single concept that has stood the test of time: the moving average. In today's video, I'll show you a simple way to use moving averages to better understand trend direction, filter market noise, and make more informed trading decisions. Be sure to watch until the end, because one small detail that many traders overlook can completely change how you view this strategy. Before exploring the strategy itself, let's start by setting up the indicators we'll be using. On your chart, add two exponential moving averages, the 14 EMA and the 50 EMA. The EMA is a type of moving average that gives greater weight to recent price action, making it more responsive to market changes. When the 14 EMA remains above the 50 EMA, it suggests that bullish momentum is dominating the market. This alignment is commonly associated with an uptrend, leading traders to focus primarily on buying opportunities, especially when price is trading above both moving averages. The 14 EMA and 50 EMA often serve as areas where price finds support during an uptrend. As the market pulls back toward these moving averages, bullish reactions can develop, creating potential buying setups in the direction of the trend. A crossover of the 14 EMA below the 50 EMA is commonly viewed as a bearish signal. It suggests that sellers are beginning to gain control, increasing the likelihood of a transition from bullish market conditions to a developing downtrend. A 14 EMA position below the 50 EMA typically reflects bearish momentum within the market. As long as price continues to trade beneath both moving averages, traders tend to prioritize short setups that align with the prevailing downtrend. The 14 EMA and 50 EMA often serve as resistance zones during a downtrend. As price pulls back into these moving averages, sellers may step back into the market, creating potential short setups in line with the prevailing trend. When the 14 EMA moves above the 50 EMA, it often signals a shift in market direction. This crossover suggests that bearish momentum may be weakening, while bullish momentum begins to take control, potentially marking the transition from a downtrend to an uptrend. With the foundation in place, it's time to bring everything together. We'll combine the 14 EMA and 50 EMA across multiple timeframes to create a complete trading strategy that helps align with the broader market trend and uncover potential trade setups. Let's walk through a few real chart examples to see exactly how it works. In this example, we're looking at XAUUSD on the 4-hour time frame. Notice how price reacts multiple times around a key demand zone near the swing low. These repeated rejection points highlight strong buying interest in the area and suggest that buyers may be stepping in, giving us an initial bullish outlook before confirmation occurs. Price then breaks above the key resistance zone, moves through the 50 EMA, and forms a higher high. This shift in market structure confirms the bullish bias on the 4-hour time frame, meaning our focus now shifts toward potential buying opportunities. You'll also notice that the 14 EMA crosses above the 50 EMA, providing additional confirmation that bullish momentum is strengthening. It's important to understand that moving averages are being used as supporting tools rather than primary reasons for entering a trade. The price action has already provided the initial directional bias, while the EMAs simply add another layer of confirmation. Price action should always be analyzed first. In this case, the potential long setup developed as price pulled back into support and formed several long wick rejection candles around a level that had been tested multiple times. This area becomes even more significant because it aligns with the bullish EMA crossover, creating a confluence zone where multiple technical factors point in the same direction. Many beginner traders make the mistake of entering immediately after seeing a reaction at support. However, a strong rejection candle alone does not guarantee that the market will reverse higher. Price can react at an important level, pause temporarily, and still continue lower afterward. A reaction is not the same as confirmation. Remember that this movement is still a pullback within the market. Until proven otherwise, that pullback can continue producing lower highs and lower lows. For that reason, we need additional confirmation from a lower time frame. The goal is to identify signs that the short-term downtrend is ending and that bullish momentum is beginning to return. Let's switch to the 30-minute chart. On the left, we have the 4-hour time frame, while on the right, we have the 30-minute time frame of the same market. The trade setup area identified on the 4-hour chart is the same area highlighted on the 30-minute chart. Notice that price is still producing lower highs and lower lows despite the bullish rejection candles seen on the higher time frame. Without analyzing multiple time frames, it would be easy to enter too early and get caught if the pullback continued lower. By using the lower time frame, we can examine the internal structure of the pullback. Drawing a trend line across the short-term downtrend allows us to monitor for signs of a structural shift. Once price breaks above that trend line and forms a higher high, we gain confirmation that the pullback is likely complete. This validates the bullish setup from the 4-hour time frame and provides the signal to begin looking for entries. Later, a second opportunity develops as price revisits support and forms another strong rejection candle. The same confirmation process can be applied before considering another long position. Let's examine another example using XAUUSD. We're starting on the daily time frame, where price has repeatedly respected a major support zone. Multiple reactions from this area suggest that buyers have been defending this level for an extended period of time, making it a key area to monitor. Before reaching this zone, the market had been trending lower, forming a sequence of lower highs and lower lows. However, once price broke above a major resistance area and established a higher high, the overall market structure shifted, providing an initial bullish outlook on the higher time frame. As gold retraced back towards support, a new opportunity began to develop. The appearance of strong bullish candles and repeated rejection of lower prices suggested that buyers were becoming active once again around this key level. Even so, a pullback should never be assumed to be complete without confirmation. At this stage, the short-term market structure could still be bearish, meaning price had the potential to continue lower despite the reaction at support. To gain additional confirmation, we move down to the 4-hour time frame. The support zone identified on the daily chart remains the same area of interest on the lower time frame, allowing us to study the internal price structure in greater detail. On the 4-hour chart, price begins to break its short-term bearish structure by creating a higher high. At the same time, the 14 EMA moves above the 50 EMA, adding another layer of confirmation that bullish momentum is starting to build. A potential long setup develops as price pulls back toward the moving averages and finds support. The combination of bullish price action, a confirmed trend shift, and EMA confluence creates a high-quality area to monitor for buying opportunities. Let's look at another XAUUSD example to see how multiple timeframes can work together to produce a higher-quality trading setup. We start on the 4-hour time frame, where gold is showing a clear bullish market structure through a series of higher highs and higher lows. This tells us that buyers remain in control and that we should focus on opportunities that align with the overall trend. As price continues moving higher, it eventually begins to pull back toward a previous support area. This is the type of movement we want to see because strong trends rarely move in one direction forever. Instead, they often pause, retrace, and then continue higher. As the pullback develops, several technical factors begin to align. We have a previous reaction level, the 50 EMA, and an important retracement area all located within the same price zone. This creates what traders call an area of confluence. Price then enters this zone and begins forming multiple long wick rejection candles. These candles show that sellers are struggling to push the market lower, while buyers are actively defending the area. We may even see the candle colors shift from bearish to bullish, providing additional evidence that momentum is changing. However, this still doesn't mean we should immediately enter a buy trade. Many traders lose money because they assume every reaction at support will lead to an instant reversal. In reality, price can pause at a support level and still continue lower afterward. To avoid entering too early, we drop down to the 30-minute time frame. The goal is to examine the internal structure of the pullback and determine whether the short-term downtrend is actually ending. On the 30-minute chart, price is still making lower highs and lower lows. This confirms that the pullback is technically still bearish, meaning a long position would be risky without further confirmation. Eventually, price breaks above the short-term bearish trendline and forms a higher high. This is the first major clue that market structure is changing and that buyers may be regaining control. Around the same time, the 14 EMA crosses above the 50 EMA on the lower time frame. This crossover supports the bullish price action and strengthens the overall setup. After the breakout, price often retests the area it just broke from. If buyers step in again and bullish candles begin forming around support, this can provide an excellent opportunity to join the trend. At this point, the higher timeframe trend is bullish. The lower timeframe structure has shifted bullish, and the EMA alignment supports the same direction. Multiple factors are now working together, creating a much stronger long setup than relying on a single signal alone. With all confirmations in place, traders can then move to the 5-minute time frame to fine-tune their entry and risk management. This allows them to participate in the larger trend while maintaining a precise and controlled execution. Notice how XAUUSD continues creating higher highs and higher lows after the entry. Every successful pullback is followed by another impulsive move to the upside, which is a sign that buyers remain firmly in control. As the trend develops, traders can use previous swing lows as reference points for risk management. If price continues holding above these levels, the bullish structure remains intact and the trade idea remains valid. At the same time, the 50 EMA often acts as dynamic support during strong uptrends. When price revisits the moving average and quickly finds buyers, it can provide additional opportunities to participate in the trend. This is why patience is such an important skill. Instead of chasing price after a large bullish candle, professional traders often wait for the market to come back into value before considering another entry. And that's the complete strategy. As you've seen throughout this video, success doesn't come from relying on a single indicator or trying to predict every move the market makes. Instead, it comes from combining market structure, price action, moving averages, and multiple timeframe analysis into one structured trading process. The goal is not to catch every trade. The goal is to patiently wait for high-quality opportunities where multiple factors align in the same direction and then execute with discipline. If you found this video helpful, make sure to leave a like and subscribe to the channel so you don't miss future trading content. We regularly share educational videos focused on price action, market structure, and practical trading concepts that can help improve your analysis. Thank you for watching, and we'll see you in the next video.